Hey guys, what's happening? It's time for another week. I took the week off last week. We were in South Carolina and just had a great time there with friends and family. And so we're back now and we're going to go live with a live stream. And what better time to do a live stream than on election eve? So let me know in the comments if you're really sick of these political ads. I think we're going to get 100% agreement with that. So no matter what who you're going to vote for, I think we can all agree that we will be glad when this is over, and we'll be glad when we can go back to normal commercials on television. So that's good stuff. Um, we've got a lot of stuff to cover tonight, and I'm really excited about something that just popped up in my model. And but before I talk about that, I wanted to talk about bees for a minute. Do you guys care if we talk about bees? I've got these beehives, and one of the things when you're a beekeeper, you never really. So when you go into beekeeping, you have no idea of all the stuff you need to know, and then once you know all this stuff, you realize that you know it all, so you have to kind of stay with it. And so one of the things that we have to be are pest control people, right? Because one of the biggest threats, one of the biggest risks to your hive is something called a varroa mite. Varroamite. Varroa mite. I think that's how you spell it. And these little mites they're small to us, but for the bee, it would be like having, see if I can get this right. If I were a bee, the size of the varroa mite on me is probably about like this. So they are really a major pest for bees. And as you know, bees are insects, they're bugs. And the varroa mite is also a bug. So how do you kill a bug growing on a bug? I mean, if you use some kind of pest control, you're going to kill your bees. So there's some things that we do that tries to manage them. I don't know that we'll ever get rid of them, but anyway, I found a new tool for that today. I went out to try to get my bees ready for winter, and they were not happy at all. I don't know, if I said something or if I looked at them wrong, but they were not happy at all. And since I have this new tool, I decided I would be, really smart and not wear my gloves, my bee gloves. I had on these like black neoprene or I forget what these nitrile gloves that I thought I could like feel everything better if I had those on, and I could feel everything better. That's for sure, because when I put that new tool in that hive, they were not having it. They came boiling out of there, and they were pelting me. I did not get stung. I did actually get a bee up in my sleeve because those little black gloves are not meant to match up with my bee suit. So I ended up with a bee up in my sleeve, and I got a sting right here underneath my arm. But other than that, I didn't get stung. But anyway, they were not happy with me. And I've got to rethink how I do this, because that was not a very good plan. So I just kind of put everything away, and I said, you know what, bees, I will think through a better method to do this, and I'll get back with you tomorrow, because you know what? It's up to me to help them manage those varroa mites. And they don't know I'm trying to help them, but maybe I can do a little bit better to kind of make it easier for them. And so they don't think I'm trying to steal their honey. Maybe that's what it is. And but yes, I do love their honey, but I'm not trying to steal it. I want them to survive in the winter. So anyway, there's my bee story for the day. Bees are fascinating creatures, though. Just the hive, the way they manage the hive, it is really cool. If you ever want to look at some cool videos, look for some bee hive videos. Those are really kind of cool. So today we're going to talk about a new stock that just popped up on my radar. It's a company that I've been following in the model, but there's been some things that happened and it actually raised it to the very top. and did some research on it. I think I really kind of like it, but we'll kind of talk about that today. And but before we get started, I want to kind of see who all's in the program as I normally do in the program tonight. Run DMS is here. Hey, what's up, guys? Pat's here. Good afternoon and evening to you. This time change thing, I mean, it gets dark so early now. I mean, it was, it's like at 5:30, it's completely dark here. And so anyway, it's just got to kind of change my routine a little bit. Michael Swami's here. Good to see you, buddy. Good evening. If you are in the U.S. and eligible, please vote. Absolutely. Every vote matters. And so do your civic duty tomorrow. If you have not already, our state, Alabama, does not offer an early voting. So we've got to kind of go to the polls just like the old days tomorrow. And so I do plan to do that. And, we'll see kind of where everything falls out. But I will tell you, I am most excited, not necessarily about who will win, but that the ads will stop. That's the thing I'm looking forward to. All right. Let's see. El Dynamico, Antonio. So am I wrong for hoping that the markets take a dive regardless of who wins the election tomorrow? I would say I would answer that two ways. I would say you're not wrong for hoping that, because as long-term investors, we know that when the market takes a big dive, there's some deals to be had out there, and those are the times that we want to be buying. So it's not wrong to hope that, regardless of whether there's an election tomorrow or not. Will there be? I really don't think so. I'm not expecting it either way. I really thought in the 2020 election that there would be some ramification from the stock market regarding the election results, and there was nothing. So, that at that point I realized, and I know that was kind of late in life, but I realized that it's not the politicians who drive the value in the stock market. It is the companies, the management teams who are making decisions every day. It's the Fed who's making decisions regarding interest rates in the economy. It's those kind of things that are going on, not whether something gets passed through Congress or not. So, I guess tax, things kind of help, but the election tomorrow, I don't think is going to have a big impact. Now watch the market either go down or up big, and then, this wouldn't have lived very long, but all right. Michael agrees. Can't wait for the election to be over. Let's see. Ex-Dividend Dad is here. Good to see you, my friend. X to the what? X to the who? Ex-Dividend Dad in the house. Jim Betts is here. I can't wait to get some dad jokes from Mr. Jim. Kevin Mendoza. Good to see you, buddy. Yeah. Happy Monday. A statement only dividend investors can make. Yeah, or retired people. I like to tell people that I have 6 Saturdays and 1 Sunday in every week. So Mondays to me are just another Saturday. That's kind of awesome. Yeah. I'll put this up here. X to the Aldoth. So there's I don't know if he's on here yet. I don't see him. Zaldoth is a guy that we know as one of our fellow dividend pals, and Run DMS has done something creative here and taken the X from Ex-Dividend Dad and from Zaldoth and combined them. So well done, my friend. Oh, right. Kevin Mendoza, INGR. Let's take a look at that in a little bit. I'm going to write that down on my handy little list, which is actually the back of an envelope. It's nothing fancy here in the Wealth Circuit investing. What do I call this? Wealth Circuit investing studio. Nothing fancy in here. INGR. I think that's Ingersoll Rand. So we will take a look at that. Um, yeah, Billy's right. I need to talk to the bees in a kind voice. My mom always said when I was growing up that I had kind hair. And I was like, what is kind hair? She said the kind that grows on the monkey's butt. So maybe that's the kind of voice I should use. Anyway, I shouldn't have said that. I apologize. But that's what she said. Ryan got pumped on one from Friday. Let's see if he stops by. Ryan got pumped on one from Friday. I don't know what that means. Pumped on one what? Give me some more info on that. I was not able to watch on Friday night. I had visitors. Actually, it was my granddaughters. And when my granddaughters are here, there is nothing more important in the world than them. So I was not able to get on the call. So Kevin voted for President Trump. Awesome. That is awesome. Can you look at FMC? I can look at that, my friend. FMC. And if I remember right, that's the agricultural chemical company. So we will take a look at that. And we've got Bernard here. Good to see you, my friend. Oh, great. El Dynamico placed his "I voted" sticker on on his performance guitar. Great job, man. In 2020, this is Jim. In 2020, if I recall, cannabis plays, electric vehicle plays, and renewable energy bumped up initially, then went back to normal soon after. Yeah, I think that's right. I think we'll probably see maybe some individual stuff, and there's going to be one that I want to talk with you guys about here in a little bit. That that might be something to kind of keep in the back of your head, but I think overall it's not going to drive the long term either way. So I'm not concerned about tomorrow. If we see a move, if it goes way down, I'll buy some. If it goes way up, I think I'll just kind of hang out where I am. I kind of like where my portfolio is at the moment. So Pat says Buffett is sitting on 300 plus billion. Maybe he is waiting a tip also. Yeah, maybe. I've kind of got near that amount. No, not quite. So I do have some cash in the background. Let me see what percentage of the portfolio it is. I've got about 5%, 5.3% cash. So that's not terrible, but it's not, not a ton either. Let's see. Greg is in the house. Good to see you, my friend. Late but made it. Good evening. Yes, sir. You're never late, man. You're never late. All right. Let's see. Let's yeah, I hear you. El Dynamico is struggling a little bit because he is legally blind. And so if he listens to the voiceover of the comments, he can't hear me. And if he hears me, he can't hear the voiceover of the comments. So that's going to be a bit of a struggle, El Dynamico. Hopefully you'll figure something out there. I have no good advice for you, but I do sympathize with your plight. All right, so Run DMS is trying to explain. Kevin Mendoza mentioned he has a new ticker for you to watch. Well, Ryan also had one that really impressed him on last Friday's stream. Well, good. Looking forward to maybe hearing about that. All right, let's go ahead and get started, man. Let's take a look at what is happening in the model. So I'm gonna pull this up. I'm gonna pull this up. All right, let's do that right there. How's that? Does that look good? Episode 45, my friends. 5 more until we hit 50. I've got to start planning our 50th episode. I'm looking forward to it. I think Ryan and Russ are going to join. So we'll try to figure out something cool for that show. So it should be a good time. New top buy stock and post-election portfolio. I think I've already kind of let the cat out of the bag on the post-election portfolio. It's really the same one I had pre-election. So, but there is one thing I think we ought to consider. There may be others, but there's one thing I think we ought to consider. So the question is, what is this stock that has popped up in my model? If you don't know what the model is, I've built a model. I track 90 stocks that I think have some, that are great dividend growth companies, and I have this formula that tries to emulate or simulate what the next year should look like for performance for this stock. Now, the only thing that I know about that model is that it's always going to be wrong. It is never going to be exactly what the market does. Why is that? Because the market does what it does. There's external forces. There's fraud that can be happening in a company. There's all these things that can happen. So, but it takes a look at the company. It takes a look at where I think the future of that company is going to go, and it looks for a 1 year price target for that. Then I take that price target and I compare it to what the average of the top analysts, what they are saying about the company, just to make sure I'm not going too far off the reservation. There's some that are, like almost right on, and there's some that are very different. So, but I rerun this model every weekend. So I update all the data for all these 90 stocks every weekend. And lo and behold, a brand new stock pops out this week. And I have looked into it, and it is very intriguing to me. And I wanted to share with you what that is. It's a little late to ask you what it is. I'm just going to tell you what it is. It is a energy company called ConocoPhillips, ticker symbol COP. It's the new top buy in the model by a long shot. I mean, it just really shot up. So let me give you some data here. This is from their latest earnings, which I think were either last week or week before. This is their year-to-date cash flow summary. I mean, they started the year out with $6.9 billion in cash. They have cash from operations, CFO, cash from operations this year of $14.9 billion. They have capital expenditures and investments of $8.8 billion. So if you take the 14.9 minus the 8.8 billion, you get free cash flow of $6.1 billion year to date through the third quarter. They have paid dividends and bought repurchased shares in the amount of $6.3 billion. They've improved working capital by $1 billion in the first 9 months of this year. And there's some other little stuff in here. But they have ended the year at ended the third quarter with $7.1 billion in cash. The cash flow statement looks phenomenal to me. There's a new transaction that's going on. They are buying Marathon Oil. Now, Marathon Oil is different from Marathon Petroleum, I think is the other one. So Marathon Oil, I think it's MOR or MRO is the ticker symbol for Marathon Oil. It's a $22.5 billion transaction. They're assuming $5.4 billion debt, and they're going to issue equity for the rest of the company. They're anticipating the close in the fourth quarter. They say that this deal is immediately accretive to earnings. They have already identified $500 million in annual, and this is cash savings, and they've got potential upside on that. It lowers the total company free cash flow break even. Now, what does that mean? That means that the price for oil doesn't need to be as high for them to break even from a cash flow perspective. I think if I will see it here in a little bit. We're going to look at Simply Safe dividends, but their break even barrel of oil cost is $35. I think the assets that they're taking over somewhere around 30. So it's gonna be somewhere between 30 and 35. I don't know what the percentage of that is, how to weight that, but it's going to be somewhere between 30 and $35. So I think that is a very good sign. Distributions, they're increasing their ordinary dividend in the fourth quarter, and this is why it popped up on my list, by 34%. They are increasing the annualized share buybacks by $2 billion from $5 billion to $7 billion upon the close. And they are committing to $20 billion of buybacks over 3 years, which fully retires the equivalent transaction issued shares. So think of it this way. They are issuing shares to buy Marathon Oil, and they're committing to buy those shares back over the next 3 years so that all of that equity comes back to the shareholders. I think that's a pretty exciting opportunity. This is from Simply Safe Dividends, ConocoPhillips to buy Marathon Oil. They have a dividend yield about 2.84%. So, I mean, it's not a high yield company. It's more of a growth company. They have a 61 safe dividend rating. And, that's not lighting the world on fire, but it's better than a sharp stick in the eye. You can see they had a 34% dividend growth. Let's flip over real quick. And I'm going to stop sharing that and go to a new screen. I think it's that one. Let's take a look at ConocoPhillips on Simply Safe Dividends. So we saw all of this a little bit earlier. Dividend safety. Here's where I got the break-even stuff. Here, let's find it. Oh, here it is. For compare, ConocoPhillips break-even average cost at its pre-acquisition drilling sites found in 13 countries is around $35 per barrel. The previous paragraph says the move strengthens the oil exploration and production company's domestic shale footprint in the lower 48 states by adding over 2 billion barrels of low-cost resources to ConocoPhillips inventory with an average estimated cost of $30 per barrel. So somewhere between $30 per barrel and $35 per barrel is where they will end up. And we'll take a look at some of these metrics here in a second. I just wanted to share that with you. All right, so let's move on. Let's look at some of the metrics here. And you can see that their latest dividend raise was 34%, but their last 5 years averages 32%. Now, here's the kind of the kicker, and one of the risks that I see in this deal, not in this deal, but in this stock, is that somewhere around 2016, they dropped their dividend like 67%, from like $3 down to $1, something like that. And then it kind of grew back slowly over time, and then all of a sudden back in 21, 22, it pops up again, and then now it's going to pop up even higher. So why does that matter? If Trump wins the election, then I think the question we have to ask ourselves is what kind of prices are we going to see in oil? And one of the ways to get inflation down is to get the oil prices down, get travel costs down, get shipping costs down, and things like that. So, are they going to be at risk here? I think we're going to see the same thing with Chevron, with Exxon, any of those type of oil inventory and drillers. I think we're going to see that issue. So I just want to point that out as a risk to this thing. Let's see. Let's look at, and they've got these special payouts that they do every quarter. It looks like it's 20 cents, which is really kind of cool. Simply Safe says that they're undervalued. If you look at dividend yield, and this is their preferred method, but if you look at PE ratio, it says they could be overvalued. So it's kind of one or the other, right? Let's take a look then real quick. So their PE ratio compared to the energy sector, it's pretty much right on. I mean, it's the same. Let's take a look at the payout ratio. We're looking at about a 40% payout ratio, which is not terrible, not too bad. You know, when it gets to be about 60, I start to worry. So if you think about it, at 40%, earnings could come down quite a bit before they get into dividend trouble. Their cash flow payout ratio is pretty similar. Let's take a look real quick at the return on invested capital, sitting somewhere in the 20% range. So that's a good thing to see. And net debt to capital is around 19%. So their debt is relatively low. And then their interest coverage ratio is almost 19, and 10 is where at least Simply Safe looks for. I look for about 8. But so anyway, it's really looking pretty good to me. I don't think I wanted to show anything else. Yeah, I will. I'll show this. Let's look them up on here. This is TipRanks, by the way. TipRanks has a really good way of showing the analysts, and that's one of the reasons I like it. So these are the top analysts for ConocoPhillips. They're saying that it's 135.22, which is about a 24% upside. If you add the dividend onto that, which is, as we saw, was 2.8% or something like that, we're talking maybe a 27% total return over a year's time, according to the top analysts. So there's that. So that's not too bad. Oh, sorry, you're not seeing this. There. I had this error on the screen, and I was going, "What in the world? Why is that there?" I've never had that before. But I guess if I share a different tab in the same screen, it doesn't let me do it anymore. But so anyway, you can see that it's 135, which has a 24% upside plus the dividend. So anyway, so let me know what you think. What do you think about ConocoPhillips? I do want to share one other thing, which is, and I've got to stop sharing and share again because they're in different windows. All right, here we go. What are the risks? One of the risks is post-election oil prices. We chatted about that a little bit. Are the prices going to go down with the drill baby drill? If so, maybe they struggle a little bit to reach the goals that they have. I don't think that they're going to be in any trouble. I do think that they are not afraid to reduce their dividend. I think they've shown that. Other companies like Exxon and like Chevron didn't decrease their dividends, but maybe that wasn't the best decision for the company. It worked out okay because prices went back up and they were able to recover that and put themselves in better position. But, maybe ConocoPhillips is managing the company better. I don't know. The other question, and this really goes for every one of them, is the future of oil. I think oil is here for a long, long time. I don't think it's going to be supplanted by the EV market. I mean, if you look at the total supply chain for both of them, I think environmentally, the EV stuff has a lot that it needs to deal with. There's going to be storage issues. There's going to be, what do we do with all these batteries when they're no longer any good? We're going to bury them underneath the ground somewhere. What are we going to do with them? So there's a lot that needs to be done there. So anyway, I think internal combustion engines are here for a long, long time, certainly past my lifetime. So I'm not concerned about that for ConocoPhillips at all. So tell me, what do you think? What do you think about ConocoPhillips? Is it worth your look? Obviously, I don't want you to buy it because I want you to do your own due diligence. I mean, this is just me kind of walking through my process. This popped up this week. I wanted to share it with you for you to do your own process, to take a look and go further. So let me see where we're at here. I think I missed some things. Get back up here to the top. All right. Yeah. Hey, Rust Moments is here. Good to see you, my friend. It's always good to see you, man. Let's see. Yep, you were right, Run DMS. COP. Cop. The cops are here, baby. Yeah, so Kenji says, interesting. Yes, sir, it is interesting. All right, my buddy Jim. I since I spent the time to read it, I might as well share it with you guys. He says, "Darn, you meant COP as in ConocoPhillips. You typed COP in capital letters, and I automatically ran to the bathroom and flushed my drugs down the toilet." Hey, it's always good to have you on, my friend. It's good to see you. Let's see. Yeah, Marathon is an Ohio company. I know Marathon Petroleum is. I actually did some work with them, in conjunction with them back when I was in the workforce. So I know Marathon Petroleum is. I really, to be honest with you, don't know where Conoco or Marathon Oil is located. So let's take a look. I'll take a look. I'll just let you know. So let's see. Show more. Houston, Texas. So Marathon Oil is out of Houston, Texas. Let's take a look at Marathon Petroleum, which is MPC. I think that's the one that's out of Ohio. Yeah, Findlay, Ohio. Yep, I've been there. So Marathon Petroleum is Ohio. Marathon Oil is out of Houston, Texas. So just to clear the air there, clear the record. Yeah, 34% dividend growth. That is a big wow. And, when you think about it, it's 32% on a 5-year basis. Yeah, 32% over 5 years. And it's 9% per year over the last 20 years, which includes the years that they reduced the dividend. So 9% growth per year over a 20-year period is not terrible, especially when they're at 34% now. If you've got a company that had some big dividends early on and now is given like 1 or 2%, but their 20-year is averaging in all the old stuff, that's one thing. But this has actually got a big, big number here recently. So I think there's something to that. Let's see. Cookie Monster. Good to see you, buddy. You are never late, man. Yeah, Kevin Mendoza says, drill, baby, drill. Yeah, I forgot to share the screen, man. I don't know if I forgot to share it, but it just, I don't know. It's being a little wonky tonight. So Alpha Spread concurs with the undervaluation of Conoco. COP stock under the base case scenario is $138.99 compared to the current market of 108.86, undervalued by 22%. So, yeah, that's I would say let's take a look real quick at what Morningstar says. I'll try to share this screen. Actually, I got to stop that one. And I get to share this one. There we go. All right, so we're back. We're back, and then we come into Morningstar. Let's hey Jim, here's a cop. ConocoPhillips. They're at 108.86. They show them with a fair value of 114. So much more conservative than what we see in Alpha Spread. But regardless, so it's a 3-star stock for Morningstar. That means that they are in a fair value range. So it's certainly fair to purchase them at this point. They have a narrow economic moat with an exemplary capital allocation. So you don't see that very often. Let's see if we have that for Chevron, CVX. See what Chevron's capital allocation is. Yeah, you guys can see this, right? Oh, there's exemplary as well. But Chevron is just teetering on the 4-star. So it is, it's a 13% discount, whereas COP was just, a little bit. So Chevron may be a little bit more undervalued than COP is. But man, that dividend growth is nuts. Why'd that go away? I don't know. But anyway, their dividend growth is like out of this world. So what else do we want to look at? Nothing. Let's come back to here. I want to hear what you guys. We're going to hit some of these stocks. I've got Ingersoll Rand and FMC. So let me know if there's anything else we need to look at. Let me get rid of that. All right. John Jay's in the house. Good to see you, man. Yeah, I missed you guys too last Monday, but it was good to kind of just be present, with the family. Plus, I didn't have to take all this equipment with me, and I have done that before, but it's a pain getting everything packed up and moved. So I appreciate you guys letting me be off last week. How many vacation weeks do I get? So Pat likes Enbridge and Energy. Is it Transfer? Something like that. ET. No matter what the price of oil, they still need to move it through pipelines. Yeah, that's right. And that's for me, that's Hess Midstream as well. So no matter what the price is, they've got to move it through the lines. And as long as they have good contracts in place that talk about kind of leasing those lines, I think they're in good shape. COP sales are down. Did you see that? Let me take a quick look. Yeah, that really doesn't concern me. I'm really more concerned with the earnings outlook. Let's see, sales. I know I'm not sharing this, but it's a good thing because I can't even find it. Earnings per share. Sales growth. Yeah, so their sales were down in 23, down in 24. Well, down for the last 12 months anyway. So, yeah, their sales are down, but I'm not terribly concerned about that. Their earnings are a little bit down, but, I'm looking at I'm looking at this dividend growth, and now, I mean, there could be something there. I guess why I'm hesitating is, it is certainly something to take a look at. But I'm not terribly concerned about it. But it's a good point. We should consider that in this process. So Kevin's buying COP. Do I like COP more than EOG? That's a great question. And I think. I mean, I like EOG. I own EOG. But I'm not buying any more of EOG. And there's, when I look at my model, where does EOG fall? That is a great question. So out of 90 stocks, EOG, there's let me do a search here. Find EOG. I thought I could find it really quick, but There it is. It's number 20 on the list. It EOG is pretty much fairly valued as well. It just doesn't seem to have the growth potential that ConocoPhillips does in conjunction with this merger. So that's kind of what I'm looking at here is the growth related to this merger. But I think that's long-term growth as well. So do I like COP more than EOG? I think so. I think at this point I do. But I'm not selling my EOG. So, let's put that there. Yeah, it has a low dividend. That's right. But I'm okay with that. There's I've got quite a bit of actually a lot of my stocks. I mean, for a retired guy, you would think that I would be wanting these high interest or high dividend yields, and I do have some that have high dividend yields, but I have a lot of stocks in my portfolio that are more growth oriented that have smaller dividend yield percentages, and I think that's just a good way to go for the future. I just don't want to sacrifice the future for current income. I mean, I know how much income I need, and if I can hit that income, I'm good. I need to just grow the portfolio from there. So VOL, who is VOL? Is that Valero? Let me take a look. VOL, Vulcan. I don't know that. Motorcycle manufacturers. I don't think that's what you mean. VOL is Vulcan, which is motorcycle manufacturers. I think you mean Valero, right? That's VLO. VLO. Yeah, VLO. Yeah, here, I'll share this with you guys as well. Oh, it's already there. All I have to do is that. So we can look at Valero here. Valero has a 3.29% dividend yield. Its dividend safety, though, is borderline safe at 50. Their dividend growth, let's take a look at that. Now, the last 20 years has been 20%, so it's much higher than ConocoPhillips. But the last 5 years, 5%. The latest is 4.9%. So it has kind of plateaued here in dividend growth. So yeah, I think I'm still. Let's see what their earnings payout ratios look fine. Their sales are also declining. Return on invested capital is lower than ConocoPhillips. So yeah, I'm still ConocoPhillips versus Valero. I think it's ConocoPhillips. That is what I believe. So, okay. Let's see. Where are we at? We are at 43 minutes. So we got a couple of stocks to look at. So Billy says he already owns Chevron and Enterprise Products Partners. I think that's enough in oil. Maybe I'll dip my toe in it. Yeah. No, that's right. I think that's very good point, Billy, is that, and again, like I say, is I'm not trying to convince anyone to buy ConocoPhillips. I just wanted to share the opportunity. It popped up in my model. And so what I do is I just share what I do. And then you guys can do with it what you will. You can look for, you can do your own due diligence and, because all of us are different, right? We all have different risk tolerances. We all have different desires for what we want our portfolio to be. And so therefore, and our portfolios are different. I mean, somebody who's overweight in oil may not want to add another oil stock. So you guys have to make your own choices there. John Jay's asking Jim Betts if that was Viagra that he flushed. Let's see. You guys are so creative. All right, let's take a look at. I'm going to get rid of this, and I'm going to go and look at Ingersoll Rand. I think this was Kevin Mendoza. So let me get this back up on the screen. And as always, I kind of like to start with Simply Safe Dividends. And the reason I do that is because everything is just right here together. So let's take a look at Ingersoll. Oh, this is Ingredion. It's not Ingersoll Rand. Did I write it down wrong? INGR. So Kevin, let me know. Ingredion. Let me know if that's the right one. So never heard of it. So let's just kind of go through this together. It's an agricultural products and services. Dividend safety is 99. That's very, very impressive. 2.39% dividend yield. The growth is pretty low, at least the last one. Let's see, what do? They manufacture and sell sweeteners, starches, nutrition ingredients, and biomaterial solutions derived from wet milling and processing corn and other starch-based materials in the range of industries in North America, South America, Asia Pacific, Europe, the Middle East, and Africa. One of the things I found humorous when I was reading about ConocoPhillips is that it listed all these countries that they did business in, and then it says, and also internationally. And I was like, it's like you just mentioned 13 international companies, and they said, and also international. I was like, oh, wow. All right, so let's take a look here. They reaffirmed it. Has a payout ratio of 34%. That's good. Very slow growth, though, in the last few years of their dividend. That would worry me a little bit. I mean, if they're growing, like this is 7 cents. That's not so bad. But 2 cents in October. That's pretty slow, pretty small. Let's see, reasonably valued. Payout ratio, very nice. Their earnings per share is growing. That's good to see. Their sales are struggling a little bit here recently over the last 12 months. They're buying back some shares, and so that's good. Return on invested capital is around 16%. And their net debt to capital is 26%. So they've got a pretty decent balance sheet. And their interest coverage ratio is 11. So, yeah, they don't look too bad. Let me see what Morningstar says about their valuation, INGR. Ingredion. Yeah, so it says they're pretty much fair valued. They're trading around 134 fair value, according to Morningstar, is around 122. So they have a narrow moat and an exemplary capital allocation. So, yeah, good stuff. I mean, it's not something that makes me want to go out and buy them, but I certainly understand the attraction. So, yeah, it's pretty decent. So let's take. Oh, am I supposed to hold on? Just 1 minute. Hold on a cotton picking minute. Let's see. Okay, I'm gonna say.
Yay! 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 Yay!
I think it's supposed to be a. Good stock. I think it's because I don't have my earphones in, so I can't hear it. But anyway, hopefully you got the good stock rating off of that. So let me know. All right, so here we go. So that was INGR. Now let's take a look at FMC. FMC, I think, is a bit interesting. So we have FMC Corp. So we'll take a look at Morningstar first. They are a 5-star company. What does that mean? That means that they are heavily undervalued. They are at a 42% discount. Their fair value, according to Morningstar, is 110. They're trading at around 63. Let's take a look at Simply Safe Dividends on them. FMC. Again, this is an agricultural chemicals company. The big issue I think for them is they have some chemicals that are going off of patent. So their dividend safety is about a 50. Let's see, remains fragile as turnaround moves forward with hopes of bottoming demand. So I've always thought hope is not a strategy. So we will just have to see how that plays out. Their payout ratio, let's take a look. So they didn't raise their dividend. So they got a 0%. Over the last 5 years, though, they've grown it by 21%. So they got a great 5-year look, but a 0 in the last year. So we can see here that January 23 was the last time that they grew their dividend. They went from 53 to 58 cents, and it has been that way 1, 2, 3, 4, 5, 6, 8 quarters. So, will they raise it in the 9th quarter? I'm not really sure. Let's see. Yeah, their PE ratio is a bit lower than the materials group. So their payout ratio is looking to get better. They struggled in 23. The last 12 months was at 84%. And now the next 12 months, they're projecting to be around 51%. Cash flow, though, not so good. They're going to be at like 89% in the next 12 months. Last 12 months was 58%. What else do we see here? Anything good? Their sales are struggling a bit. Went from 5.8 billion to 4.5 billion in the last 12 months. Well, 22 to 23 anyway. And return on invested capital has decreased from 17% in 22 to 6%. So, yeah, I don't know. I know that this net debt to capital is 45%. Their interest coverage ratio is not good, guys. It is 2 versus what we'd like to see is an 8 at least. So, yeah, FMC is not impressing me. I know it is recommended by Morningstar, and you guys know that I do enjoy the Morningstar subscription that I have. But I just don't see it. It's something that something could happen, and they could do very well, but I don't know what that catalyst would be. I don't have a good what's it called? I don't have a good investment thesis for FMC Corp. So what that means is it's a boo. All right. So there we go. Those are the 2 stocks you guys wanted to see. And let's see. Let me kind of catch up with you guys now. Let's see. I'm not even sure where I left off here. Got to back up a little bit. That's too far. Oh yeah. I'm catching up with you guys. Here we go. All right, there was that. Okay, got it. I think we're here, man. Let's see. So RoboHandTech bought COP at the second few weeks in October. That's so good. Okay. That was good because I think they popped it. Their earnings caused the shares to pop like 6% or something. So you did good, man. So Jim always burns up one of his three free searches on Alpha Spread on Monday. That's awesome. So oil can also be moved by truck and tanker. Yes, that is true. Not just pipelines. Yeah, so Gendry's on the program. So it's good to see you, my friend. And Hershey is in drawdown. They are below my cost basis. So they actually have them on the list as potential. Let's see where they fall. they're number six on my list. So it won't be too long if it continues to go down that I'll probably be picking up a few more shares of Hershey. It's about 2.8% of the portfolio. So I've got some room to move there. I think long term, we'll see some good things from them. I do think they're going to struggle, though, in the next few quarters as this cocoa price thing has lasted much longer than anybody thought. I think their hedges have been burned through, and we're going to see their cost of sales rise. I think that they're going to struggle, and I think that's what investors are pointing to here, is that they're going to struggle here in the next few quarters. But as a long-term investor, I am not concerned about that at this point. Okay, my buddy Russ is here. What's your take on Wina? W-I-N-A. They're on my radar and own Play It Again Sports. Okay, yeah, no, that's been around for a while. That's good stuff. So let me take a look here. I've never heard of it before. So Winmark. So Simply Safe has no rating on it, and let's see if they got some history. Man, their dividend's growing like crazy, man. That's awesome. 22%, last 5 years, 41%, last 10 years, 32%. That's incredible. They've got these special payouts. Man, look at that. Every year they're paying out like $9.40, $8.40. Hey, I better get in there and get some. The ex-dividend date is the 13th, so we've got about 9 days left for the $8.40 payout, if that matters to you. Let's see. Earnings payout ratio is not bad. They are, though, one of the things, Russ, that I like to see. So take a look at this. The earnings payout ratio is historically been in the 6, 7, 8, 11, 10, 15, 23, 28, 30. So while they're growing their dividends significantly, their business is not keeping up with that growth. And so one of the things I like to see is a consistent earnings payout ratio so that I can then say, hey, they are growing their dividend, and then I can depend on the growth of that dividend to mock the company's growth, if that makes any sense. So, earnings per share ratio is growing. It's not high. Don't get me wrong. I'm not concerned about that. But what I'm concerned about is that they're giving away more and more dividend, but they are not growing the company in that same percentage. So at some point, they're going to have to pay the piper. So just an observation is all. Earnings per share is flat, so that's something to take a look at. Return on invested capital, wow, 184% over the last 12 months. That is phenomenal, man. Yeah, you can't hardly beat that. I just don't know why they aren't growing their earnings with that much return on invested capital. So I'd need to look at them further. Their interest coverage ratio looks fine. So, yeah, I think. Let me see. I don't think if Simply Safe is not covering it, I doubt that Morningstar is. But we'll take a look. But no, they're not. They don't cover it. So $383.84. According to the what is that called? A quantitative model in Morningstar's world, they are trading at an 80% premium to fair value. So got that going for you as well. So anyway, those are my thoughts. When you come here, you're going to get my honest thoughts, honest feedback. That doesn't excite me at all, to be honest with you. I would need to dig further into it, but just the way that they're managing their dividend doesn't match what the business is able to do. So I think it looks impressive with the dividend growth, but the business growth is not supporting it, in my opinion. Russ or Ryan brought up HSM and didn't look good from Simply Safe dividends. I think you had to explain the rationale. Oh yeah. So that's Hess Midstream. It's HESM, and yeah, and to be honest with you, Hess Midstream has one customer, and that customer currently is Hess Petroleum, which is currently being bought by Chevron. So when that happens, then Chevron will be their sole customer, and I think that creates some tension for Simply Safe Dividends, because one of the things you want is to have multiple customers. So if you lose a customer, it's not as big a deal. If you got one customer and you lose that one customer, you're in big trouble. So I think that's why Simply Safe Dividends does that way. Those are my thoughts, but. So Gendry's asking, do I like CE 14% after hours? So let's see. I don't know if I like them or not. I don't even know who they are. Let me just see who this is here. CE. Oh, Celanese. Okay. So they're up after hours. Let's put them in over here. CE. Yeah, they're up almost 16% after hours now. They must have had earnings. It's got the earnings call here. I could play that if you'd like. Probably not. Let's see. Yeah, they must have had a bang up earnings report. So, yeah, I don't see anything in here yet. It says their profit decreased and they missed estimates. So, I don't know. They must have given some kind of indication about the future so we'd have to look and see what's causing that. Yeah. So do I like them? I'm not really sure. I don't track them. So I've looked at them before, but I don't track them. I think they can be volatile. Let's take a look at, let's say, the 5-year. They can be a bit volatile. Volatile is not the right word. It's cyclical. Cyclical is what I'm looking at. Let's go 10 years. You can see how cyclical this stock can be. So I tend to stay away from cyclicality. I'll get in it if I want, if I've got another investment thesis, but they just because of how cyclical they are, I don't tend to follow them. So man, that's a good call though. That's a big jump. Yeah, EOG is the only good that came out of Enron. So Greg says, "Don't let your wife catch you looking at your model." Yeah, I have to do that in the privacy of my studio here. That is right. So CNC is a good company at a fair price. I think maybe fair price. Let's see, CNC. Throwing these tickers at me that I don't know. Centene. Wow, the analysts say there's a 30% upside. So you may be right. Might be one that I need to look into. CNC. I don't even know what they do. Managed healthcare. That's interesting. They don't offer a dividend though. Yeah. So it looks they got a 10% return on invested capital, which is not lighting the world on fire. Interest coverage is not that great either. So yeah, there's some positive things. I mean, look at the earnings per share growing up and to the right. That's incredible. Their sales are growing really fast. So, it could be a nice pickup if you like stocks that don't have a dividend. I'm going to write it on my list here, but I'll take a look at it further. So yeah, I mean, it sounds like it's pretty decent. Let's see here. Yeah, let's see. Dun, dun, dun. Yeah, and Russ, this is a great point. Let me get this off the screen. Sorry. Um, this is a great point by my friend Russ. And anytime that we buy a stock, and I did this with ConocoPhillips as well, I wanted to understand why people would not buy it, because sometimes we can kind of get in our own world and we can say, well, we kind of get married to the stock before we really know all about it, or we fall in love before we know all about the stock. And sometimes it's good to kind of step back and say, why would I not buy this, right? And then so if I'm looking for dissenters, on ConocoPhillips, then it's good. And so when folks say, hey, what about this versus this, I think those are great questions to ask, because at the end of the day, it's important that we find out why we would not buy a stock. So ConocoPhillips is and then for Russ, it's this new stock he's looking at. I forget the ticker already, but it was the Play It Again Sports Wina. No, I think it's WINA. Let's see. We are at an hour and 6 minutes, so I think we're gonna look for a jumping off place in here. Let's see. Oh, wow, cool. Russ says the ingredient used to be Corn Products, and their headquarters are 10 minutes from his location. So that's kind of cool. All right. I'm not seeing anything else that is lighting the world on fire here. So there's one here that I will look at. I just wanted to see if there's anything else. So I'm going to go through this, and then I'll be done for the evening. But let me find it. I lost it. Huh. That's pretty bad. All right, so this and then one more. So Billy's been buying NTR in the last few weeks and ELV. So Billy, I just want to let you know that I bought a little bit more ELV this past week as well. So it is now 2.6% of the portfolio. My model says that I should expect a 19% return on that investment over the next year. Analysts are saying about 31%. So, it's I don't think we can go wrong in the long term with Elevance Health at this point. So that's good stuff. So one more thing, my buddy ex-dividend dad, look at FMCS latest earnings. So FMCS, Fidelity Mid Cap Stock Fund. No, that can't be it. Oh man, I don't want to leave on that note. We need maybe the ticker's not right. FMCS. So I'm not sure what that is, my friend. Because right now all I see is this. I see FMCS takes me to FMCSX, which is Fidelity Mid Cap Stock Fund. I don't think that's what you're looking for. So anyway, maybe we'll pick that up on the next one. And so as my buddy Michael Swami says here, hit the like button. So that's awesome. Hey, it's been a great week, guys. Looking forward to getting the election done tomorrow. Looking forward to not getting these emails and these text messages and these commercial ads it's going to be really kind of cool. So so next week we'll pick it up again. We'll see if something else pops up on the radar. And we got a Fed meeting coming up. There's a Fed meeting this week, so don't lose sight of that. It is high probability for a 0.25% decrease in rates. So if that doesn't happen, it's going to be bad news. If it's more, who knows? Maybe it's good news. I doubt that they're going to do anything wild. They're just probably going to do the 0.25 and move on. So it'll be an never mind, no brainer. But don't forget that it is this week as well. So we got the elections and the Fed meeting this week. So take care, guys. It's great to be with you on the live stream back on a Monday night. So I will see you guys on the next one. Have a great week.